Hi there. On this week's edition of Women's Wednesday, let's take a closer look at the power of financial independence. My colleague Kavita Thapliyal is in conversation with Kruti Cheta, the fund manager and fixed income analyst at Mirae Asset Investment Managers India, who shares the to-do list for investment for women. What factors should you keep in mind when it comes to investing in fixed income funds? Let's go across and listen in.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to this very special edition of Women's Wednesday. I'm Kavita Thapliyal and today we'll be focusing on fixed income strategies for our women investor and women viewers. To throw more light on this, I have with me Kruti Cheta, fund manager and fixed income analyst from Mirae Asset AMC. Hi and welcome to this show. So let's just first understand in short, what is the importance of fixed income strategy or investment in your portfolio?
When you're making a portfolio, you should have all kind of investments, and we can take it through a simple example of, your typical Indian thali, which has protein, carbs and fibers in it. According to your need, you can lessen or increase. If you're going for a bodybuilding, you might have more protein in your diet. If you want to go for a weight loss, probably you'll have more fiber in your, plate. But it depends that what is your target. So if your target is wealth creation, definitely you can have more riskier assets on your portfolio. But for the stabilization, because your portfolio needs a stabilization, you need to keep some of the conservative asset also in your portfolio. So therefore, an wholesome allocation with a target of what you are trying to achieve, but at the same time stabilizing the portfolio is very important. So it depends that what age and what risk appetite you have. So if you are more towards your retirement, then probably you would have more of a wealth preservative in your portfolio, versus if you're a young and and an earning professional, which will have more of a more risky assets on your portfolio. So it's a wholesome that you need to have, but an asset allocation can vary. And fixed income acts as a stabilizer, because if you are someone who is towards a wealth creation, but we often forget that we have interim expenses that we don't account for. So having a fixed income in your portfolio helps you gauging those, going through those expenses in interim without touching your wealth creator, so that you don't have to break into your investments to go take a trip or maybe a medical emergency. So therefore it is very important to have a allocation of fixed income in your portfolio.
So you are saying that it mitigates your risk?
Yes.
And gives stability to your portfolio?
Yes.
Okay. So now when you talk about fixed income, usually people think about fixed deposit. What kind of fixed income instruments are you referring to right now?
When we say fixed income, because I am from mutual fund, I am primarily referring to mutual funds. And why we say that, obviously fixed deposit has its own importance, but often people don't consider mutual funds because they don't understand that what is fixed income. But the beauty of this category is that there are around 16 categories which is there, and an investor can choose to invest from 1 day to 10 years. There is that broad of a category which is there, depending on the need of an individual. So if an individual says that, I need to lock in for 3 months, there is a product for that. If an individual says that probably after 3 years I need my money right now, I just want to participate in the market, there is a product for that. And if an individual says that, I need a stability and a long-term product, there is a product for that. So there is a wide range of product. Now if we talk about a comparison to FD, in fixed income, even if you're saying that I'm investing for a 3-year product, but you decide after 1 month that I need that money, there is an easy liquidity which is available to you.
You can withdraw the money
anytime
without any penalty or without any cost, any exit load?
No, nothing applied. Your liquidity is easily, as much as you just say that I need this money, you get that money, versus what FD has a penalty in it. Second is that when you go for a mutual fund investment, which people don't realize is that the interest rate which is there. So if the interest rate is 7%, if you are investing 100 rupees, the interest rate is 7%. At the end of the year, whole 7 rupees is invested. Versus in FD, because you are taxed every year on FD, when you are investing 100 rupees and there is a 7 rupee interest rate which is there, when you want to reinvest, you will be able to reinvest only 5 rupees because you have to pay the tax that year. So imagine that the 2 rupee that is getting accrual every year, you are actually losing it if you are investing for a 3 year or a 5 year or a 10 year. And over a long period of time, it matters because it would make a difference to your portfolio for almost like 1.5%.
Right. So that's the return difference also we're talking about?
Yes.
Okay. And on taxation point of view, what is better, fixed deposit or debt mutual funds?
If you're talking from a taxation point of view, your mutual funds become better because you are taxed at the time when you redeem the portfolio, that is at 3 year or 5 year. Till then, till you don't redeem, you are not being taxed. For FD, you are taxed every year, irrespective of whether you redeem or you don't.
Okay, okay. So listen, when we talk about having a fixed income portfolio and the presence of fixed income in your portfolio, is it wise to just avoid fixed deposit completely? Because, India, we love fixed deposit, okay? And for a lot of people, investment means fixed deposit. So can we have any strategy of diversification within fixed income only, where you can have fixed deposit and also a couple of fixed income mutual funds or debt mutual fund in the portfolio? Can we diversify it that way?
Of course, you can. See, if an individual thinks that fixed deposit is something that I'm more comfortable with, then they can keep invested in fixed deposit. But if an individual is thinking, probably up to 1 year, I think it's fine that you are investing in fixed deposit. But if I am talking someone who is investing for a 3 year or a 5 year, I would say that they should make a mix of a fixed income, like, debt mutual fund rather than going for a fixed deposit. Because in fixed deposit, what is shown to you, that 7% will be 7%, and at the end of the year, you will get that 7% only.
Sure.
When you're investing in a mutual fund, you get the benefit of the market movement also. So with that coupon or interest rate, that 7% is there. If the market is on the positive side, then you make the capital gains also on it. So there is an added benefit when you invest in mutual funds. So I would recommend from a taxation point of view and market participation point of view, yet wealth, preservation, your mutual funds are better. And if you're thinking of a short term, then probably fixed deposit is a good option.
But then no investment is risk free. Okay, we all know about that. And because through debt mutual funds, we are somewhere participating in markets, what are the risks involved?
There are two kinds of risks involved when you're investing in fixed income mutual funds. One is your interest rate risk and one is your credit risk.
Okay.
Interest rate risk is that if your interests are going higher in overall economy,
like the current scenario.
The current scenario, if the interest rates are going higher, then there would be some mark-to-market loss that would be there. Okay, but over a period of time, if you are a 3-year investor, then you will see that circles down because your market cycle comes back to, it's a typical 3-year cycle which is there. So interest rate risk is something which is very minimal and which can be taken care of. The second risk is something that an investor should always look at, that is credit rate risk. When we say credit rate risk, means that the portfolio, if it's investing in an securities which are more companies which are not very strong or have some financial disruptions or are more volatile, those are the ones which can do a permanent damage to your corpus. So whenever an investor is investing in a fixed income scheme, they should see the rating profile. So a AAA rating is a maximum rating which gives you stability of the portfolio. But anything that AA or A category of the credit ratings are there, that is a red flag which is there. Then investors should understand that this is the risk that we are taking. And obviously you'll get a higher interest rate, but the risk is also higher involved over there.
All right, so it's time up for me on this discussion. Thank you so much for taking time out, and I hope all the viewers and women viewers especially, you can just diversify and even look at debt mutual funds as a fixed income investment option. Thank you so much for watching. Goodbye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.